A lender can approve you for a house that still becomes a very expensive mistake. Not because homeownership is bad, and not because renting always wins, because approval only answers one question. Will a bank make this loan? It does not answer the question that matters if your job changes, your family changes, or you need to move. Can this house survive your first 7 years? In one clearly illustrative example, a buyer puts $92,000 into the deal before getting the keys. 3 years later, if the home price is flat, selling returns only about $63,000 after the remaining loan and assumed selling costs. That is not a housing forecast. It is a stress test. By the end of this video, you will be able to run the same 7-year test on one real home and reach one of 3 answers: buy, rent, or wait. The Warnadrin set the rules 031-058. We are not using a national average home price and a national average rent as if they describe the same neighborhood. They do not. Instead, imagine 2 similar 2-bedroom homes in the same invented metro. One is for sale at $400,000. The matched rental is $2,250 per month. Every local number here must be replaced with a real listing, a lender loan estimate, local taxes, an insurance quote, HOA documents if relevant, and a probable seller net sheet. The method is the product. The numbers are just the demonstration. Both households start with $117,000 in cash and protect $25,000 as an emergency reserve. That leaves $92,000 for the decision. Let's run the test. Blueprint 1. The first trap is comparing rent to only the mortgage payment. In this illustration, the buyer puts down $80,000 or 20% and budgets $12,000 for closing costs. That is 3% of the price. The Consumer Financial Protection Bureau says closing costs typically range from 2 to 5%, excluding the down payment, but the real number changes with the loan, property, and location. The remaining mortgage is $380,000 fixed for 30 years. Using Freddie Mac's published 30-year average of 6.69% as a dated illustration, not a quote, principal and interest are about $263 per month. But principal and interest are not the whole house. For this condo-style example, add a local tax assumption of $360,000 per month. Add $150 for homeowner insurance. Add a maintenance reserve of $3,003 per month, 1% of the home price per year, and $150 for HOA dues. Now the number is not $263, it is about $363 every month. That is $613 more than the matched rent at the start. Your property may have no HOA, a different tax rate, flood insurance, or a much higher repair risk. That is exactly why the full cost stack belongs in your test. The CFPB includes taxes, insurance, mortgage insurance where applicable, and HOA fees and total monthly housing cost, and separately tells buyers to budget for maintenance, repairs, and utilities. There is another rule before the next blueprint. The emergency reserve stays outside this comparison. If your down payment and closing costs consume the cash you need for an unexpected job loss, repair, or move, you have not made yourself safer by becoming an owner. You have made the purchase fragile. Blueprint 2. Now put the house on the 7-year bridge. The buyer's first check is $92,000, $80,000 down, plus $12,000 in closing costs. That money does not all become equity. At these loan terms, after 36 payments, the buyer has paid about $74,000 in principal and interest. Only about $1,180 reduced the loan balance. About $63,080 was interest. That is normal early amortization. It is not a hidden fee. But it means the first few years are a very different financial event from year 20. If this kind of clear money math helps, subscribe for more visual money systems. So use a deliberately cautious exit check. Imagine the home sells after 3 years for the same $400,000 price. For this stress test only, assume selling costs equal 7% of the sale price. That is not a national seller cost claim. It is a placeholder for a local seller net sheet that includes commissions, concessions, transfer charges, and anything else that applies. 7% of $400,000 is $28,000. After the assumed selling costs and the remaining loan balance, the seller receives about $63,000. The house did not necessarily lose value, but the buyer gets back roughly $28,120 less than the $92,000 initially committed. before we even compare the years of monthly housing payments. Now change one assumption. If the home grows at 1.7% per year for those 3 years, the sale price becomes about $4,749. After the same stress assumption and remaining loan, cashback is about $83.6, still below the original cash in. That 1.7% is not a prediction. It is only a reference point. FHFA reported 1.7% national year-over-year home price growth in the first quarter of 2026, and local outcomes varied widely. This is the purpose of the bridge. If you are likely to move in 2 or 3 years, you are asking one home purchase to absorb 2 expensive transactions on a very short timeline. CFPB makes the same practical point. Buying and selling involve fees, taxes, and commissions, and a buyer should expect to stay long enough for those costs to make sense. So do not ask, could I live here? Ask, how likely am I to need to leave before this bridge gets strong? Blueprint 3. This is where most rent versus buy spreadsheets quietly rig the result. They give the buyer every dollar of home appreciation. Then they give the renter a perfect investment return on money the renter never actually invests. The fair rule is simple. The renter is only ahead on paper if the renter automatically invests the cash difference in real life. In our illustration, the renter starts with the same $92,000 available for the decision and has a starting cash flow difference of about $613 per month. To make this test honest, the renter sets an automatic transfer for that exact monthly difference. No heroic discipline. No, I'll invest whatever is left. Automatic. Now look at 3 paths after 7 years. They are scenarios, not forecasts. We hold the local rent and owner cost inputs flat in today's dollars so the comparison stays transparent. In real life, rerun the model with your expected lease renewals, tax changes, insurance renewal, and repair needs. Path 1. Cautious, the home price is flat. After the same 7% selling cost stress assumption and remaining loan, the buyer exits with about $81,962 in cash. If the renter's initial cash and monthly difference earn a hypothetical 4% annual return, compounded monthly, that account is about $181,000 before taxes and investment fees. That does not prove renting wins. It proves that a flat price, 7-year ownership path can have a high liquidity cost. Path 2, middle. The home grows at 1.7% a year. The buyer exits with about $128,350 after the assumed exit cost and remaining loan. If the renter's investments earn a hypothetical 6%, the account is about $204,000 before taxes and fees. Again, not a market forecast. It is a reminder that the buyer and renter each need an explicit return assumption and both are uncertain. Path 3, buyer friendly. The home grows at 3% per year. The buyer exits with about $167,275. Now imagine the renter saves the cash difference but never invests it. The renter has about $103,343, the original $92,000 plus 84 monthly transfers with no investment growth. In that path, the buyer's home equity is higher. Not because ownership is magic, because a longer stay, stronger price growth, and weak renter discipline change the result. The winner is not the house or the market. The winner is the system you actually follow under the life horizon you actually have. And remember what these exit balances leave out. Taxes may change the comparison for some people, but they do not create a universal homeownership bonus. The IRS says homeowners generally must itemize to deduct eligible mortgage interest and real estate taxes. Limits can apply, and many ownership costs, including insurance, HOA fees, repairs, principal, and most closing costs, are not deductible. Treat tax treatment as a personal review item, not as a spreadsheet coupon. Blueprint 4. The 7-year test now becomes 4 questions. First, can I probably stay long enough? Not perfectly, nobody can promise that. But look at your job, relationship, family plans, commute, immigration status, military orders, and the chance that this home stops fitting. If a move inside a few years is likely, short horizon transaction costs deserve more weight than a 20-year appreciation chart. Second, can I pay the full owner cost? Use principal, interest, taxes, every relevant insurance line, HOA, repairs, maintenance, utilities that change, and a cushion for estimates that prove too low. If the purchase only works when you ignore those lines, it does not work. Third, does the emergency reserve survive? Your closing cash is not your entire cash position. Keep the money that protects you from the normal surprises of life. A house should increase stability, not make a broken water heater a credit card event. Fourth, if I rent, will I truly invest the difference? If the honest answer is no, do not compare yourself with an imaginary renter who automatically invests every spare dollar at a perfect return. Build the automatic transfer first. Then the rent option becomes real. Here is the decision rule. Choose buy when your likely stay is long enough to absorb local entry and exit costs. The full owner cost stack fits without touching the emergency reserve or sacrificing critical goals, and the home still feels resilient under a cautious price path. Choose rent when a comparable home leaves a meaningful, automatically investable difference and mobility has real value in your next several years. Choose wait when the reserve would fund the purchase, an early move is likely, or the full cost does not yet fit. Waiting is not failing the test. It is the test protecting your options. Renting is not throwing money away if it buys flexibility and you invest the difference. Buying is not automatically an investment win if it turns your cash reserve into a bridge you may have to cross too early. Find one real home. Replace every illustrative input with your local numbers. Run the cautious path before the optimistic one. Then make the decision that survives your life, not just the lender's approval screen. If this system made the decision clearer, subscribe to the Finance Blueprint for more visual money systems built for real choices.
If you found this analysis valuable, leave a like and comment. It helps the video reach more people who care about long-term financial thinking. And subscribe to the Finance Blueprint for more structured breakdowns of the world's most important financial ideas.